So tonight, we have 4 gentlemen that are going to help those innovation contest winners bring their ideas, their technologies to market, to actually make to make a go of it. So before we do, first I have to again thank our sponsors, because without our sponsors, we would have no innovation contest. So those are Pannoni, KCI, Mont McDonald, Innovize, Northrop Grumman, Clark Nexon, Charles Pankow Foundation, and Kleinfelder. So a round of applause again for our sponsors. So I'm going to give the mic now over to Jerry Buckwalter, who is from Northrop Grumman, one of our sponsors, also a member of ASCE's, ILC, and I think I can call you the godfather of the innovation contest.
Here, here. Now I'm scared. Okay, thank you very much. I'll start by just turning this over for some comments from the team of 4 behind me, and then we'll open it up a little bit later for some of your questions. My one contribution to this has been to simply make sure Carol drew sharks with smiling faces on the T-shirts instead of the really horribly aggressive faces that were on there before. Matt Garver, head of Liberty Street Capital, been involved with infrastructure projects, been involved with all sorts of civil engineering projects, privatization projects, socially responsible investments, and a whole series of things, has been a compatriot with me in the committee that launched this innovation contest and has orchestrated this event for us. So with that, my thanks to Matt, and I'll let you take it from here. Thank you.
Thank you, Jerry. My name is Matt Garver, as Jerry said. I'm the CEO of Liberty Street Capital. We are a socially responsible venture capital and private equity firm. And we, as he mentioned, we have been invested in water, clean tech, a whole range of companies over the last 20 years. A lot of work in the infrastructure, and I've been very proud of my work here with everybody here on the Innovation Committee when it started several years ago. And let me take just a few minutes of what we're going to try to do here tonight and go through kind of just to set up the stage, if you will, and then I'll introduce these 3 gentlemen. The goal here tonight is really an introductory, how do investors see innovation? How do they invest for the long term in the face of disruption? What does innovation mean to investors? So that's what we're going to start to explore here. We're going to talk about how people bring projects to market, how they finance them, what that looks like. We have 3 different type of investors, and we're going to go through each one of them and what the subtleties and the nuances, how they invest, what it looks like, what their expectations are, and how they conduct those investments and how they manage them across the years. But let me step back really quickly and just kind of set the stage for a moment. You know, today we talked a lot about the grand challenge of lowering infrastructure costs by 50% over the next generation. And that is a very worthy goal. 2 things have to happen. One is that we all have to innovate as an industry. We need to innovate together. We need to innovate on our own. But we need to learn to create a culture of innovation. And the second thing is we need to learn how to work alongside capital partners. Surely to achieve that type of goal, these 2 paths must cross. So we're going to start that conversation tonight. When we were at the Northrop Grumman Center today, we saw these moonshots and these huge game-changing technologies. And for me in my life in the last 20 years, innovation has been about a lot more. It's more subtle, it's more personal. Sometimes it's a micro change, doing something differently. Sometimes it's a macro story. So it's a whole range of things. One of my favorite definitions is creativity is thinking of new ideas. Innovation is doing new things. And the scale of what people are doing today has never been done before. The scope is really quite innovative. The people going to Mars, people talking about private space, talking about robotics and driverless cars. This is not in our lifetime. We're in the execution phase of these technologies really coming to market and having an impact, unlike anything we've ever seen before. So we want to talk really about what that looks like, what does that look like to investors, and how we as a community, as an engineering community, can figure out how to innovate better, how we work alongside capital partners, and what this conversation needs, the next step, where we need to go with this conversation. So with that said, let me just take a moment to introduce these three gentlemen here and really give them a quick update on who they are, where they are, and how they invest. And then we'll open up the conversation a little bit more. I'll moderate for about 30 to 40 minutes. And then we've got some questions that we're going to go through. And when we go through the group questions, I'm going to participate in some of those answers as well. So to my left, your right, is Matt McGraw. He's the CEO of Optimize Capital. He is traditionally a more early stage investor. He is an innovation in itself, as they are the largest crowdsourcing platform, institutional crowdsourcing platform in all of Canada, and one of the largest in North America. And I'll let him describe it, but they're more under the venture capital stage and doing earlier stage. So a lot of the companies here today and the contest winners, this is an interesting platform because it's innovation in private equity altogether. Next to him is Mark Reiser. Mark Reiser works for one of the largest family offices in the world. He is a private equity investor. He's been a venture capital investor for the last 30 years. He's invested across a whole range of industries. And so we'll get his experience as a direct investor, a manager of investments, and how innovation has worked for them, against them, and how they see the world. And then next to him is Jed Friedlander. Jed's the president of Hunt Companies and also the principal with Amber Investment. They are a different type of investor, larger scale investor, infrastructure investor. They do large scale projects. They own large construction, integration type companies. So he represents more of an infrastructure finance type of partner. And we'll get into that. But so we've got from my left all the way down is venture capital, more private equity, and then we'll say private equity as it relates to infrastructure investment. So that's the distinction, and that's what we want to draw out in this conversation. In about 30 minutes, what we want to do is open up this conversation to you guys and really have a dynamic discussion. So any questions that we have are open up. Matt, let me start with you. If you would just take a minute, introduce your company, how you guys see it, how you work with companies, and what that means for you and for partners that come to the Optimized Capital platform.
Sure. Thanks, Matt. So I run, as Matt mentioned, a firm called Optimized Capital out of Toronto, and formed it myself about 9 years ago. And early on, recognized a huge opportunity to really bring investors and innovative companies together. There was a massive funding gap then, and certainly there remains one. And we set out to build the OCMX, which is an online institutional crowdfunding platform. Thankfully, we now have tens of thousands of investors. These investors are predominantly accredited investors, family offices, venture capital firms. The companies that list with us on the OCMX are, as I said, very innovative. So it does span a number of different sectors, but the one commonality is certainly these are companies that, like many of you in the audience, are setting out to disrupt their respective industries. The size of the transactions that we help complete range anywhere from 1 to 5 million typically. We've done larger and we've done some smaller, but those are predominantly the size of the transaction. And the structure is predominantly growth capital, so equity capital and the like.
Thanks. So let me ask you one question
Sure.
before we go to Mark. You have roughly 40,000 accredited investors.
That's right.
How do you handle that level of demand of investment?
Sure.
And say only a quarter of them are active. That's still 10,000 investors.
Yeah,
That's
sure.
pretty challenging.
Sure.
So how do you manage that?
Sure.
And then how do you help provide enough pipeline of good investments for them to find projects that they found worthy?
Sure. So as you said, a lot of what we do is in and of itself innovative. So a lot of the deal flow that gets screened by these investors is first and foremost done through our online marketplace, so that creates a huge amount of efficiency right then and there. The investor pitches themselves are typically done through WebExes, online screen shares and the like, as opposed to the traditional road shows that investment banking and corporate finance firms have done. So that really improves the efficiency to the point where you can handle that volume of investors.
Yeah, that's great. Thank you. Mark.
Hi, I'm Mark Reiser, and I was thinking about your response and actually thinking about how we're lined up here, and it's kind of interesting because when you think about the funnel of opportunities, you're dealing with a very large funnel, early stage companies. We're dealing with a smaller funnel, what I call middle stage companies, and Jed is probably dealing with a smaller funnel, bigger stage companies. So with that in mind, Morningside is what I'd call a middle market private equity fund, or really a family office. We've been around about 30 years. We have a large Hong Kong-based Chinese investor as our main investor for 30 years. And we invest in businesses which would be a handoff, so a growth stage to what they call buyout in my industry, but a little more mature, but still high growth. And those businesses are really pretty mundane. A lot of infrastructure. We've owned terminal businesses. We own ships that pull up to terminals. We've owned barges and towboats, interstate gas pipelines, et cetera. So we focus on businesses that have a little lower risk profile, have a little more certainty of getting your capital back, but still have a little bit of opportunity to innovate, which would be product expansion, geographic expansion, business expansion, acquisitions, things like that. So we're kind of in the middle, and we invest anywhere from $5 to $30 million of equity in these transactions. A difference between us and a traditional private equity fund is that because our capital is perpetual, we can stay and invest as long as we want. We'll stick with a company for years. So our average hold period is about 10 years. And we don't usually get out until someone knocks on the door and wants the business, or the management team says, hey, I'm old, I'm tired, this is too big, I want to retire. So that's how we get involved. When we get involved at a board level, just like these fellows up here, quarterly board meetings, monthly management calls, key decisions, either product or people. And then, lastly, it's a very small group. There are only 3 of us, and everybody's old. We have no young people. I'm old.
You're the young guy of the group.
I am. Indeed.
So the industries across that you invest, you've done pipelines, you've done infrastructure services, right. You've done broadband, you've done a whole range of services. Which industries are the most innovative, and which ones are kind of stuck in the lack of innovation? And does that change how you think about investing in them?
That's a great question, because I can tell you that if the government, state, federal, local, or regulations have a big hand in it, we become less interested. And by that I mean, if the demand is based on a regulation, the risk is greater of opening up the paper and reading a headline that some regulation has now changed. So we will shy away from those unless there's an opportunity to commercialize it. Yeah. Then we get involved. Yeah. So we look at them differently.
Well, that's one of the key points for today is engineering firm and the engineering community often wants to innovate, but has customer sets that don't want to innovate. And often they're being hired to risk manage and design to that. So it's almost a contradiction at some level to innovate in an industry that with customers that don't want to innovate. So it's a tough challenge. We'll touch back on that some more. And Jed, give us just kind of an overview of Hunt and Amber and kind of the scope. And also, if you wouldn't mind differentiating how you do venture as well as private equity and infrastructure as a differentiation point for all of us.
Yeah, sure. Thank you, Matt. Jed Friedlander, I focus on, as Matt said, North American infrastructure development for Hunt companies. Hunt is a family-owned company based in El Paso. We have a lot going on. We are the largest owner and manager of military housing in the U.S. We're also a very large owner of apartment units. As recently as 2014, we were the largest owner of apartment units in the U.S. A couple years ago, we bought 50% of a company called Amber Infrastructure, which is a UK-based concessionaire infrastructure developer. They manage a publicly traded infrastructure fund on the London Stock Exchange with about $3 billion in assets, about 150 different public-private partnerships. These are all long-term deals with the public sector. So we work with them extensively on infrastructure development in the U.S. These are project-specific pursuits, but we also have I guess what you might call a portfolio, a private equity type portfolio of companies at different stages. We have a construction affiliate that's a $1 billion plus company. We have a company that provides facilities maintenance. We have earlier stage companies in the energy space. We have a combined heat and power company that we brought from pre-revenue to now having a decent book of business. I'd say what draws them together is that we like long-term, stable relationships with public sector clients. We like companies that allow us to do that in increasingly better ways. The more services we can offer, the more interesting that is. And I wouldn't say that we don't necessarily go into something looking to innovate, but because of the sector in which we play, you often get there because there's so many doors that are closed to you that you're eventually going to find yourself in a box and have to innovate to get something done to solve a problem for the public sector.
Yep. So let me ask you real quickly. You do early stage venture, and you've done that in the past, although that's not a focus. You've done private equity. You largely buy companies just outright. You don't do a lot of co-investment work. And then your infrastructure portfolio is fairly large. And that's something we want to explore here further. And sure, we'll get some questions from the audience. But take us through what a public-private partnership looks like overseas, and then what it looks like here in the United States. Just most people in this audience know where this question's going. But I just wanted to kind of frame out, you're doing large-scale, could be multi-billion-dollar projects.
Yep.
And how you play in those type of projects, because that's relevant to the grand challenge, but it's also a bigger question to innovation as well and delivering large-scale projects.
Right. So this portfolio that Amber has, 155 projects, and Hunt's military housing portfolio is similar. These are largely projects that are publicly procured. There's a competitive process. It's well known when they come out. They're usually a two-step procurement where you supply qualifications, how great you are, all the projects you've done, who's going to be on the team, how big you are, and then you're shortlisted to say 3 or 4 people, and then you provide a fixed price proposal with committed financing. And in that proposal is what you're going to be paid for. This is I'm talking about social infrastructure. This is different from toll roads and airports, but so I'm talking about courthouses, schools, hospitals, that kind of thing, mostly water projects potentially. You're giving them you're bidding to the public sector a fixed price that assumes all your risk, all the risks that we're taking to design, construct, finance, operate, and maintain a project for, say, 30 plus years. And competing against lots of teams, it's a tight market. There's a little bit of equity. There's long-term debt, a lot of long-term debt. And then, I'd say that's a variant on what we've done. That's the international model. Say in the U.S., it's because of the presence of tax-exempt bonds. The way that the U.S. procures infrastructure is different. A lot of times, if you're doing a public-private partnership in the U.S., you need to try to equate what you're offering with the government's perception of their cost of capital with a tax-exempt bond. That's a low cost of capital. They can issue bonds for 3+%. So they They often will throw in real estate that they want you to assign some value to. They often will ask you to monetize some asset that is maybe part of the project. I've looked. People always ask me about naming rights, whether I can assign some value to that. It's a much different process than the international one, where you're just looking at, a province or a country to provide you stable annual payments every year.
Yep. Thank you. That's great. So as you can see, we got 3 investors, completely different spectrum where they invest, how they invest, where they invest on the maturity scale and the development scale. So each series of questions I'm going to start with here is a little bit different and tailored to the particular investor. And really what we want to do is draw out the nuances and the difference. Matt, let me start with you real quick.
Sure.
How does, obviously people come to the platform, they want to work with you as an investor on behalf of your investors. How do you prepare? How do you determine whether somebody's worthy of investment? 95% of the people who come to you, you don't work with. What is that magic 5%? What does that look like? And how does that affect some of the people in the audience who are going to call you tomorrow?
Yeah, right. Yeah. I think, great question. First and foremost, it is the people that are behind the business or the concept that they're looking to take to market or take further along the market. The credibility of the management team is really what people invest in, especially at the earlier stages that we're dealing with companies. So credibility of management is number one. Number two, their plan to take their product or service to market needs to be very quantifiable. Obviously, there is a problem that they're solving, but their actual business plan or execution plan or implementation plan needs to have very quantifiable milestones and goals that they can deliver upon. And that has to be, or those have to be directly tied to the money that they're looking to raise, so that we can see, okay, you need $1 million, how exactly are you going to spend it? How are investors going to know that it was a success or not as successful as you thought? So a clear action plan, credibility of management team are really fundamental to how we screen for potential businesses.
And you go up and down the scale as well. So you'll do a $1 million project, a $3 million, and you've done a $20 million project. Does it look different across that scale when you're looking for more money? Is it a value proposition that's different than when they were a $2 million company? How does that work?
With the larger transactions, there's a lot less risk. So it comes into who is the right partner from a capital structure perspective. On the smaller transactions, it's really who's the right partner based on the particular business. So, for example, a lot of times we find the $1 million deals that we arrange are arranged with companies that are much more mature than that specific business, but they're in that sector, so they get it, they understand the risk, they're comfortable with the risk. Whereas the ones that are $5 million and beyond are, really with a myriad of potential venture capital firms or private equity firms. There's clearly revenue, there's clearly profit, there's a return on the investment that, the best and worst case scenario is quite narrow at that stage.
Yep, thank you. Mark, same question, but a little differently. So Matt will help launch these companies with the first $1 million or $2 million, and then they come to you, and they need $30 million. What does that look like? How do you look at the innovation? How do you look at the team? What's important to you as you look at investment for those type of investments? So if you wouldn't mind giving, an example of some projects or something of that nature.
Sure. So again, thinking about the transition here, it is sort of he's thinking of an A, B, C, D round. We would be a Z round. We're a little farther along, but seriously, maybe a little farther than that, a little less farther than that. But it is a trade of risk and reward. So we will take more interest in a business that has a little less risk and a little less reward. And when we look at those businesses, for us, it becomes almost more about the management, because the business model is probably a little more proven. They have proven products and services. They have market share. So they have a demonstratable track record of producing revenue and cash flow regularly. So then we look at the management team. That's what we focus on, because we're going to be investing with these folks for a long, long period of time. As I said, 10 years. We'll spend a lot of time with them, and they will with us, making sure that we are a good fit. And that doesn't really matter the size, whether we're making $10 million or $50 million investment.
So chemistry really matters.
It's important. We're going to be partners for a while.
So that's interesting. Both of you guys have said the technology is important, the business model is critical, but the management team is absolutely essential and indispensable.
Right.
That's interesting. Jed, your question's a little bit differently. You guys are a large-scale investor. You're across many spectrums, from early stage, buyout stage, and infrastructure stage. So to you, the question is, how do you innovate at scale? There's a lot of people here in the audience that run large corporations, and they're struggling with the challenge of innovating at scale. And so the question to you is, how do you guys view it? And what do you find important? And how do you determine what's a good investment and what's not a good investment?
Right. I mean, I get the challenge to innovate is, I guess it starts with what additional value can we bring to our clients. So it doesn't always work out exactly how we plan it. We have a portfolio company that does combined heat and power, CHP, that we bought into it, I think expecting it to be a vehicle for long-term energy contracts with public sector partners. It didn't really work out that way. We were too early in the stage to get a lot of our public sector partners, clients to buy into it. So we had to establish proof of concept with much smaller commercial projects. So instead of going into libraries and schools and hospitals, we started with grocery stores, with ShopRites, and we amassed a portfolio of those. And now those have been operating for a few years, and we can take these potential public sector partners and say, hey, look, this actually works. This actually saves you money over time, provides you backup power. It's a little bit, I think, a little bit the reverse of what we heard at Northrop this morning. A government application that then you say, this has a lot of commercial uses. It's a little bit of the opposite of that.
Yeah.
I'd say, it generally depends on, there are other instances where you see innovation happening industry-wide. When we work with construction companies, I don't know if we're alone, but I think everyone requires virtual design in construction right now. You see everyone's using BIM. It helps us make pretty low-cost bids when we're pursuing these projects in a competitive way. I think you see that happening on the edges, but I think that switch from CAD to BIM came very quickly, and that is something that has just swept the industry. And I think it's partially developers requiring it of our partners, but also owners, public sector owners, saying we want to actually be able to see what these buildings are going to look like. Put on the goggles and go in when it's halfway built and see what the wall is going to look like.
So let me take that a little further and ask the question, what is the role of capital as it relates to integration? And let me tease that out a little further. You're bidding on large-scale projects. People in this room or potential smaller partners can play a role in helping you design a solution. And then not only are you investing in those projects, but you can also put large-scale capital alongside some of those projects. So your CHP example. Talk about how capital, even though it started off a little differently than you wanted to, how you're entering the market almost sideways, essentially, but how once you get 3 to 4 or 5 projects, you can start to deploy larger scale capital to help build some of those projects out. Take that for a little bit.
Right. I mean, so in that CHP example, we've basically everything we've been able to do is funded with all equity. Not everyone is in a position to do that. Once we've recently gotten to scale where we can actually put some debt, we can cross-collateralize, take all these projects and put some debt on them as a whole. Without that, I think without the ability to put that equity capital at risk, I don't know how those projects are accomplished. A grocery store does not have the credit, a single grocery store does not have the credit to back a bond so that I could install and pay for an energy system. We've talked about smart lighting, smart city projects. You see there's lots of opportunity to improve energy efficiency at a public level, but also a commercial level that, at least commercially, a lot of times the people who could really benefit from efficient lighting, for example, can't afford it, don't have the credit, don't have the ability to prepay the cost of all those lights. So you find equity, you find capital really opening up the opportunity to innovate and say, hey, we're going to spend all this money at risk. We can take a risk on you for 20 years and earn our money back over 20 years and still give you this great energy saving so that you're realizing a significant profit from this transaction.
Thanks, that's great. Mark, let me ask you a question. You guys bought a series of port terminals in Australia. Mm-hmm. Here in this country, as we all know, pick up the newspaper every day, there's a big push for another infrastructure spend. One of the components of that infrastructure spend is modeled after Australia, where they're recycling dollars into projects, selling those projects, taking the monetization, take the capital, and deploying it somewhere else. You did that in Australia, where you bought those terminals.
Right.
Would you take us through what a deal looks like in that situation? Take us through how you evaluated it, how you saw it, what the capital structure was. Go into some of those details to give a flavor of the complexity of some of these transactions.
Sure. So in Australia, for the last 20 years, they've been really deindustrializing their country. And what that means is, as it relates to this, they have, through this public-private partnership that they probably started years ago, they have started to sell state assets that were state assets because they were geographically important, ports, and monetize those and put them into other services. And I don't know all the services. Along those lines, because of competition in Asia, corporations started deindustrializing their assets. And what I mean by that is the big refineries, which were small over there, 100,000 barrels a day. Singapore, for instance, has million barrels a day. They started to sell assets because they couldn't scale. They did not have enough capital and weren't going to get enough return on capital to build those refineries bigger. And so they sold those assets, like an Exxon and a Mobil, and they put that into farther downstream, retail, gasoline, fuel jobbers, refined product that they could import. So, fortunately, we saw this opportunity where we saw the state selling assets and we saw commercial business getting out of the assets that were used to fill up the tanks. And so we started buying these terminals from the state. As the refinery started to close, we had to build more terminals. So that was the investment thesis. And so the way that deal worked was we bought a set of terminals, and they're strategically important because you're not making more land. And we were able to grow that business substantially from 7 million of cash flow to about 50 over 10 years. And it was because of this sort of weird dynamic of what was going on there. The state allowed us to get into the business. The direction of the industry allowed us to actually take advantage of that opportunity. And we built tanks, we stored more products, we expanded the business dramatically.
Yeah, that's great. And then you exited and sold that.
And then, and this again is sort of a transition, right? So we then sold that business to it was a big process. We sold it to large multinationals from all over the world who were interested in a business of that size, because we took it from a little riskier business, smaller, to one that was very stable, very mature, like a bond. And I don't know if you guys know what this means, like a cap rate. So they start bidding on what the return on assets is, and it's really low. And so the valuation goes up dramatically.
Yeah. That's great. Thank you. Matt, let me turn to you and ask a series of questions. As you guys are putting together programs, can you give us an example of what a deal looks like? Give us a couple examples. And I would ask a second question is how you are positioned in the market. So there's a whole range of crowdsource operations. And then over here, you've got venture capital firms. And you guys are really doing the larger institutional rounds. But can you kind of tell us how that works? And then an example of a project that you've worked on that's
Sure.
interesting.
Sure. So when you think about the OCMX, size of the transaction, 1 to 5 million, early stage growth company, typically those are the hardest transactions to get done. And I know that there's a lot of people in this room that, are at that stage. And those are ones where you can't just pick up the phone or head on out to an established venture capital fund and expect a term sheet. So you really need a partner, I would argue, like us, that is going to roll up our sleeves or roll up their sleeves alongside you and help you with things that perhaps you haven't even thought about, such as putting together a data room, putting together the offering documents, putting together the investor pitch deck or pitch book. So really getting yourself organized to get in front of these investors. And again, our investors could be venture capital funds, but quite often they're accredited investors, so wealthy individual investors that pool together to invest. So the check sizes could be as small as $25,000. Typically, they're larger than that, but you pool those together and you can put together a $1 million round of financing. So we do work alongside VC funds or venture capital funds, but we really are a little bit earlier stage than that. So typical transaction that I could think of was a company that was recycling tires and creating energy out of this, or another one was or had developed a technology that they could go out to large bioethanol refineries and help those refineries get more efficient and get more output out of their existing refinery. It was very capital efficient, so the business model was exceptionally or particularly attractive to investors. Both of those transactions were small. They're $1 million each, but worked out very well for investors. A question that that you haven't asked, but I want to answer or bring it out is advice for companies or executives of these types of companies. Often I see people making the mistake of focusing on the structure of the financing that they're looking for. So, whether it's preferred shares or convertible debt or straight equity. And what I always say to them is, really focus on the type of investor that you're looking for. And if that type of investor is interested in investing in you, really take whatever it is that they're offering, because it's much more important that you align yourself with the right partner as opposed to the quote-unquote best financing structure.
That's great. I appreciate that. That's great advice. Mark, what would be some of your advice about doing deals and looking for capital and raising capital, and similar to Matt's comments?
Yeah, so in a mature business, we don't get as hung up on structure. So I agree with you there that you're really going to want to focus on someone, especially at our stage, who can help you add value and maybe take a little more risk. Because again, where we look, the businesses are a little more established, they're a little more mature, and you're making small changes to the direction of the ship, not big 180-degree changes. So I'd say focus on someone who actually has experience in your industry, someone who has connections in your industry, someone who has a broad set of experience if they don't have directly that experience, where they can bring to you, like my partner has 30 years, I'm 20 years into this, lots of scars to show you of how not to do it. And those are pretty darn valuable because, if you've never been down this road of taking capital and growing a business, it's easy to stumble and go in a different direction. So I would really focus on, as you said, the kind of partner that you think can be helpful. As far as structure, we'll use a little more debt than an early stage company. That's cheaper for the owner or the founder because debt is 3 to 5% and equities 10 to 100%. It just depends on the company. So we'll take a little more debt and the company can afford it. And then what we focus on, once we have a structure and a team and an investment thesis, and usually the entrepreneur's taking a little money off the table so they can say, hey, if everything goes badly, I have some money. Then we'll take a little more risk with the business with them. We'll expand the plant by 50%. We'll enter new lines of business. We'll bid low a project to get the business and then put in, implement Lean and Six Sigma and all kinds of operational efficiencies. We'll take those kinds of risks with the business. And if that all works out with the founder, we close the deal and we go marching forward and hopefully we still get along in 10 years.
Yep. That's great. Thank you. Jed, different question. How do you integrate firms like this into your packages? How do you basically attempt to aggregate different technologies to develop prototypes and beta types on your existing portfolios, different projects? How do you view that? And maybe an example of something that you've done. You mentioned smart cities as maybe, as a framework for something like that.
Yeah, I think on a typical public-private partnership type project, as a developer, as the equity provider, most of the risks of that project we're pushing down to either the designer, contractor, or operator. To the extent that design engineer, that there's an innovative solution there, it usually will come through one of those work streams. So generally the designer is going to take. You're winning those projects, I'd say, for the most part, because of design and pricing. And we need to look to our designers to say, we can absolutely stand behind this design that we give you for however many years you need us to. Same thing for the contractor. And then the risk, if there's some defect, actually passes to the operator for, almost 30 years in most cases. So to answer part of your question, the best way is, I think, to make your service known, make your innovation known at those levels of people that we partner with to present the most competitive solution to a public sector project. Smart infrastructure is a little bit of a different area because it's smart cities, smart infrastructure, because it's still evolving. I don't think that the public sector really understands all that they're going to be able to do with it, and the extent that maybe we can commercialize some of these other revenue streams coming off of that in a way that you can't with a courthouse or a hospital. So I think in that we're looking for people who can give us an idea about, for example, what is the data worth that is being collected by these sensors that we're installing on streetlights. For example, a lot of the smart city, smart infrastructure projects start with smart lighting projects. And once you have that infrastructure on the light pole, what else can you put on top of that? We've had some conversations again about what if we're collecting, say, congestion traffic data. What is that worth? Can we monetize that? Can we offer some savings to our public sector partners because of that? We've even talked about advertising, as a way to subsidize those projects, which would be very far afield from a traditional kind of P3 project.
So you're really looking to partners to help create, not only apply technology solutions, but really design innovative business models. And that's really almost the key for you, is how to monetize and how to capture some of these value flows that are probably not captured in the traditional format. Is that right?
Yeah, I think part of it is where can we bring additional value? Can we offer free Wi-Fi, free secure Wi-Fi to Washington D.C., where we're looking at a smart lighting project? And then part of it on our side is where can we get comfort that ultimately, if something goes wrong over 30 years, our equity is at risk and our reputation is at risk. So can we look to our partners to provide the stability and the security that we need to be able to say to the public sector partners, we're going to perform this way, meet all your expectations, incorporate technological innovations over time for 30 years.
So one more question before we open this up. The scale innovation that we're seeing is breathtaking. It's a little terrifying. It's a little daunting altogether. And it's the same question to all three of you, and I'd be curious how you all answer it. Is the innovation we're seeing today, is it an opportunity or is it a threat to existing businesses? And how do you determine the difference?
Certainly a threat to the, I'll speak from a Canadian perspective, and I'll speak from my own sector's perspective. Financial technology is really changing the way that finance is done, from both a raising capital perspective as the OCMX and what we're doing there. So just think about how that's disrupting the traditional investment banking firm. A lot of the small investment banking firms, frankly, are just not surviving. So that's a major threat to those types of firms. It's an opportunity to our firm. Robo-advisory is also picking up a lot of momentum in Canada. So the traditional way of receiving financial advice is being changed to a more automated, transparent, objective manner. So the traditional commission-oriented stockbroker, I mean, that would be a massive threat to him or her, but a huge opportunity to the new next generation robo-advisory type firms. So, definitely both, but I think it's necessary, and that's how we've always gotten ahead. So it's all good.
Same question.
So for our businesses, because we invest in things that weigh a lot, it's usually attached to the ground except for the ships. It's usually products or distribution of tangible products, not soft products, and some services. There's probably less opportunity for us with this digitizing of the whole world. A little bit more of a threat in two ways. So if I think about our business, and that might be collectively us, digital technology just provides for more intermediation, for more people to get involved in a transaction, right? The ability to close. And what that really means is there's just a lot more chances for it to be intermediated in some way, someone to get in between and say, oh, great, we're going to raise money for you, and different than what you do, but here's the price, $1 gazillion. And so you say, gosh, that's a lot of money, and that just means lower returns. So the risk to our investing model is more information means discovery of value, which means lower returns. As far as the businesses, because they're kind of old school, it's really a threat of not keeping up. Meaning, if you don't stay relevant in keeping your business in front of people, then someone's going to pass you by. I'll give you the best sort of extreme of that. We have a log home kit business, like big boy Lincoln logs. You get the logs, the door, the floor, the subfloor. You get everything. We make the whole kit, we design the thing, and we send it to your site and it gets built. So in 2007, it was trade shows, conferences, paper, advertising, radio, TV, just as old school as you can get. The internet was, that might stick, but we're not quite sure yet if it's going to be around. After 2009, just like a lot of businesses where I think recessions give you a chance to lower your fixed costs, because you have to. But then when things rebound, you don't put the fixed costs back on, there's variable. So we went from no advertising online to 90% online. 99%, actually. We just try paper once in a while just to see. And even more so, just last year, our guys are, they're thinking still old school, and we say, hey, look, guys, this social thing, that seems like it's going to be around for a while. Why don't we try that? It's like, yeah, we do a little bit of that. And so, because we're on lots of boards of different companies, I was on 6 boards. I was on a front-facing electronics company, radios, and that's all they did. And I said, well, you know, these guys, they don't spend any money on Google Ads, and they have a lot of market share. So we talked to those guys, and sure enough, we started doing that, and now 30% of our leads come from social, right? A year ago, 0 or very little, right? So it certainly is, even for old economy business, it's a threat if you don't keep up, because someone will pass you by.
Yeah. Jed, same question before we open up to the audience.
I think that generally, I think we embrace it. We don't see it as a threat. I mean, what we're doing as far as these public-private partnerships in the U.S., that's an innovative way to deliver infrastructure. It's this idea of infrastructure as a service. To the extent that we can incorporate new technology, new ideas, new methods faster than the public sector is doing so when they traditionally procure something, I think it just helps drive that value proposition that's core to why P3 works in the U.S.
Right. Let me open it up, and what we're going to have is 2 microphones, Jerry and Carol. And if you have any questions, entertain any questions from any direction.
I have a pre-planted one that I got in advance, so I'll start with that and let everybody else think about what they want to ask. Actually, I have 2, but one is we're always looking at servicing hugely the public sector, and we have these barriers. You guys have talked about it. As we think about how to knock down the barriers, or maybe champion the incentives to innovation or to improve performance, I heard 2 things. One, there was a description of a business model in Australia that was quite different, that enabled those kinds of things to happen. I heard with Jed, kind of, okay, orthogonally going out to the commercial sector, and then you drive it back through. Is there any other things that this industry can think about? I mean, I don't want to assume the answer is, okay, let's all go look non-US solutions, and then, because that's where it's happening better. You know, we'll go to Canada, we'll go to Australia, forget the US. Or that you always have to go to commercial and drive it. Is there any other incentives or methods or ways to drive down the barriers other than the 2 that you mentioned?
Great question.
Things that we should look for.
I mean, we're participating pretty extensively in pilot programs, most of which are on a federal level, and there's, you know, it's the trick in the U.S. is when you're doing infrastructure development, if you're not doing it at federal level, you're doing it either at a state level, meaning you have 50 constituents to worry about, or a county city level where you have thousands. So it's hard to get repeat projects at that smaller level and build up the trust that, you know, yeah, this innovation, this new solution is what we should use going forward. So I would say, I mean, you're seeing pilot programs in smart infrastructure. You're seeing them in, you know, airport privatization
Look for the
at a federal level.
Yeah.
You know, Jerry, this is where I become part of the panel here. Let me give an example, real life example. In a company, we've invested $40 million of equity into it. It is a biological wastewater treatment system, knocks down organic materials, and we work for cities, counties, food and beverage companies, hospitality companies. So we'll do a hotel in Mexico, we'll do a food plant in Singapore. In the United States, like Jed's example, where we had to take a tack and it was wrong, or the path to market was so challenging or so difficult, or more than we expected. One thing that we're doing in that company that I think is innovative and nobody has done yet is we have an energy savings of roughly 40%. And one, we've got to get the project designed, built, and we've got to pay for it. Usually these customers don't have any money. Usually these customers really don't want to change anything. And they'd rather pay fines to the EPA for effluent standard violations than fix the problem. So one thing that we have done is we are trying to monetize the energy savings in that water plant to basically build the plant, lower the cost, really provide water as a service, but monetized and paid for out of the energy savings that we're capturing. And there are programs that are doing that, but they were so difficult, we ended up just lining up our capital partners to be a leasing portfolio for that. So we're doing water utility, but we're having to do it all equity. And as a result of that, we're getting projects launched, but it is much more difficult path to market. But our approach has been lower cost and energy savings as a means to monetize it. So it's a variation on some of your questions.
A lot of these folks might be raising money for the first time. Are there some standard do's and don'ts, do's that might help them as they're preparing for you, their model, or what they're going to say, or how they present it to you, that might help pique your interest? And are there some red flags that have a tendency to discourage your interest?
Great question. I think that's one we're all going to try to answer, because I think we have different answers for all of that. So Matt, maybe we start with you.
Yeah, I think one of the big ones would be if you're at the early stage, the last thing that you want to be putting forward to a potential investor is your preconceived notion of how much your company is worth. And it gets worse if you come up with, market comps and tables, and this is why the business is worth 10 million or 20 million. I think that really turns off investors. I think, again, going back to one of my earlier points, if you're sitting down with the right investor, and that right investor could be family or friends, quite frankly, those are usually the best early stage investors, or it could be a particular VC fund or strategic partner, whatever that entity or person is. If they're interested in investing in you or with your company, the last thing you should be putting forward at any stage, quite frankly, is why you think the business is worth 10, 20, 30 million. It really is a red flag. And really focusing on this is your go-to market strategy, or this is your development strategy, and here are the very quantifiable milestones. So to me, that's a major red flag when I meet with people.
Yeah, I would say part and parcel to that. I agree it's a turnoff when someone says, yeah, it's $1 billion. I don't hang up, but I say, great, I wish you luck. But are the terms and conditions. So that's the other thing, right? It's the valuation, the terms and conditions. So if you don't say the value, but you say, gosh, I want this structure, what you're not allowing to happen is the market to tell you, right? You're not discovering the value in the structure, which is pretty important, because you might learn a lot about why it's not valued as highly as you think, which it never will be. It'll be close, but it never will be what you think, and that's fine. But you'll learn. You'll learn, like, gosh, what am I missing? And what are they seeing in my business model that I don't see because I have this preconceived notion of terms and value? The second thing I would say, it's not a turnoff, but it's, I think it's something you got to think about. So I'll back up just a little bit. I'm an aging engineer. I've forgotten all this stuff. But as we discussed, I think of it as a black box, like stuff goes in, stuff comes out. This is how much goes in volume-wise, dollar-wise, and this is how much comes out. And if you think about engineering versus what I do today, as I jokingly say to folks, I used to focus on things that had stuff at the end of the numbers. Now it's focused on stuff with a dollar sign at the beginning. So you got to be able to translate that stuff you're passionate about and say, this is what it means to the business on a per unit basis, a per project basis, but be ready to do that, because most investors can't get into the weeds like you can. They're just going to keep coming back and say, you put the stuff in, you get the stuff out, doesn't make sense. And then they'll run the numbers and it's like, that's pretty good. That's a good return, or that's a good return on sales. So be ready for those kind of things too. If you're not, it's unfair for sure, but an investor might say, gosh, he really understands the engineering part of it, but he's not really converting it into the economics, which I think as a founder, entrepreneur, CEO, see everything, you got to be able to do both. It's a lot of balls to juggle, but I think you got to be able to do that.
Let me take a shot at that answer. I'm not going to touch valuation because I agree, and I've got some funny stories to share with you, actually. One of the two critical issues, one is a lot of entrepreneurs attempt to boil the ocean. They're trying to do too much, too quickly, and they usually get that wrong. I think focusing on acute pain, you're solving some particular issue. and you have to solve somebody's pain. Even so much, I would say, you should know exactly what the profile of your customer is, where he is on an org chart. If your customer is Northrop Grumman, you need to know that you're talking to a vice president or more, or maybe you're talking to a division head, but they need to know specifically what that customer looks like. So many times we've gone into investments not knowing those answers. And the answer is you spend a lot more money, it's longer dated on the project because you didn't get some of the really fundamental acute pain issues addressed up front. One quick funny example, we were lucky to invest in Unicorn, a project that is worth $1 billion that has no revenue. Go figure. And so we started seeing a lot of unicorns. Last year we saw a company named Juicera. And it was a juicer, you guys probably read about this in Bloomberg, they popped the bubble on this one. They went out, this is a valuation question, they went out and said we're a pre-money billion-dollar company, we're raising $120 million for a juice machine. And at that point I said, all right, the end is near, and we're not doing that project. But it gives you an example of, they raised it. They raised $120 million, and it's a $750 juice machine, went to $450, and the answer is, you don't need a juice machine to take the packs that they were selling. So really knowing they were just caught up in a frenzy, and they were raising huge sums of money. So that narrative really can catch on as you go through the story. So, more questions?
Thank you very much for the presentation. I just have a question, or maybe just hear your thoughts regarding long sales cycles companies. You correct me if I am wrong, but I believe that in civil engineering, specifically in companies that are involved in infrastructure projects, well, they have long sales cycles. We are not selling 20 million iPhones a year. We don't have 20 million customers. Rather, we have 2, right, in a year. And well, if you're Bechtel or Skanska, you have 30 years of experience, then your business model is proven. But as a startup company that I'm in my way to have a business model where I have to have a long sales cycle, is that something that is my company less investable from your side? Is something that you will find as a high risk investment? And if so, as an investor, what would you like me to show you or to tell you to ease maybe that, or to lower that risk?
Great question.
I think Jed should answer that one. I have an opinion too.
I guess in what I went immediately to an infrastructure bidding process in that situation where you're investing a lot of money up front and you're not getting anything back unless you win, and as equity you're really not getting anything back until the construction is finished and you've started paying off your senior debt. I don't know if that's maybe not exactly what you have in mind. We obviously try to limit our exposure there. We try to have a developer fee at a closing that pays us back for what we're putting at risk. What you, I think, need to be aware of with your question is that we have an equity return expectation. If you're asking for money to be paid to you, to this company, it's going to start accruing at, depending on the risk, 10 to 100%, and people are going to expect that to be accruing on an annual basis. So if you're not paying it back for 2, 3, 4, 5, 10 years, the payoff has to be much richer than if you're paying it off sooner. So when we put equity into an infrastructure project, it's usually, if we can, it's the last capital that is spent on construction because it's the most expensive capital.
I would say, I was thinking about what you had said before about going into public versus private. Sort of as an aside, and then I'll answer your question. I think if you're already in the public sector in some way, selling services or products, it's easier to go into commercial because you're a proven entity. If you're not in that and you have a startup, to me, you might as well just run at that wall 100 times because you're never going to get through it. To me, in the public sector, there's not a demand for the product. You might have created the newest, greatest thing, but they're not demanding it. you're not solving a pain, right? But the commercial guy may say you are solving a pain because that lowers expenses or increases revenues. Very simple, one of those two. So my opinion is you're more likely to want to enter a commercial market with a product that you think is better suited for public because they're going to take forever. That's just the way that's the nature of any of them. IOUs, public utilities, probably infrastructure projects like roads. Tying it to what he said, if you do go to public, it's really time value of money. If you don't really produce money until year 8, he still wants the same 25% return. So you can do that math. That means he's probably going to make 4 times his money. So that means you got to really knock it out of the park, right? But if you get into the commercial sector and you can return the money in 2 or 3 years, it's a better deal for you. It's a better for him. He's de-risked his investment. Does that make sense, or is that what you're kind of, yeah?
You know, I would also add, we've been in engineering, we've been in facilities management, energy, water. All of them were long sales cycle. It was a huge issue. And everything they said is absolutely right. One thing that we took that circuitous route to the private sector to get launched so that we could establish a real operating company, and then came back to the public sector for the exact same reasons. We didn't plan for that, and so our cost of capital was always on the clock. But it was something we had to do. And they mentioned it in their CHP project. They did kind of the same thing. So it's something you have to plan for, and you need to expect 2x, 3 times as long. If there is another route, take that route to get started, prove the demonstration, prove the validity of the technology or the solution, and then try to reintroduce it in small ways. That's what we attempted in numerous different markets. So.
And there, if I can add as well, there might be a hybrid solution for that type of scenario as well. So it reminds me of a company we worked with where there was a long sales cycle. There was certainly a lot of capital required up front. It was a business that had come up with the technology to convert eggshells into a lot of very exciting byproducts. But there was a lot of capital involved to really monetize on that. So what we did was we brought them to one of the largest egg farmers in Canada, literally massive company. And here are these guys, like 2 or 3 guys, and they had their prototype, and I was grinning to myself as they were making the presentation. I thought, isn't this exciting to see? And that was really the right partner. And so this company offered them not an offer to invest in their company, but really to take them in-house and say, guys, why don't you come on in-house? We'll pay you a nice salary. Don't push her anymore. Still is very entrepreneurial and de-risks a project tremendously. And not to get to your family as well, right? Because embarking on these ventures, is taxing on not just the entrepreneur, but the family as well. And this will go back to an earlier point of mine. They were fixated on the valuation of their company, the fact that it was a company, and they took the offer, said thanks very much, and declined it. And now they own 100% of a company that's no longer, right? So, when you get the right partner and they offer you something, you really should take it. So, yeah.
Thanks for the discussion. It's very insightful. And one thing I've realized in this industry, especially when you're dealing with the public infrastructure, there's a resistance to change. We're so used to the way of doing it, and there's a lot of resistance because a lot of personas involved, which is bad and good, which is like it's difficult to get into the mainstream line. But once you try to get over the peak, so then you're steady, you're in there, it's very difficult for you to go out of that streamline. But especially when you're evaluating these new companies with the technologies, so based on your past historical experiences, how do you see the path to success for any of these companies for them to get to the mainstream side of it? If it's a new company, new product side of it, how do you try to evaluate your perspective on how difficult would it be, or what is the time does it take for this company to become mainstream or try to pass on those hurdles and get into the specifications or some of these things, because it's highly regulated of what we can do versus the new things. So insights or thoughts based on your historical experiences, what you have seen?
Any thoughts?
Do you mean within civil engineering or within public infrastructure? Or
Within civil engineering and construction, the design and construction side of it, with the new technologies.
All right, I'd like to take a shot at this. So I did a little homework today. I went to the ASCE website, and I said, all right, what's the mission of the ASCE? It's to deliver value to members, it's to advance civil engineering, and to protect the public health, safety, and welfare. So those are all fine missions. And in the code of ethics, number one is safety is paramount. And then there are a number of other things: be nice, do unto others, be fair. It says a lot more than that. So, you know, nowhere in that's innovation or entrepreneurialism or risk-taking, which is all fine. But to me, you know, what that says as an industry, and I go back to what, you know, in engineering school, it's a structured way of thinking, it's a structured way of operating, it's a structured way of executing, with the goal being don't fail as number one, don't hurt anybody as number two, and then make some money, which is all fine and good. We're in a building that's hopefully not going to fall down. But what I think that means, if you're trying to launch a business into the public sector where you have more stakeholders than you know because of all the people that can have a say, it's just a very tough thing. So I think you need to go in knowing that in those kinds of industries, they are designed to say no, right? They are designed to say, why take the risk? There's no upside, it's just downside. So it's kind of a negative way of thinking about it. I just think you have to be prepared to say, here's why. And if the economics are so compelling, I mean, if it's just, I won't say it's a no-brainer because there are plenty of those out there, but if it's a no-brainer, you just got to find the right entity that's going to take a risk. And once you get one, just like Jed was saying, they did it with the commercial, but if you get one, then they'll start talking and then it'll grow. It's going to take a while. That's my opinion.
I think the question's at the heart of the issue. So an engineering community whose customers don't want to innovate. And how do you overcome your customer? You don't want to trade off customer service for a little bit of innovation, which may or may not pay off. It's a very tricky conundrum. And I think it's at the heart of the overall question of how do we as an industry attempt to innovate. I think there are pockets of innovation. We should talk to customers about exemptions from some of the rules or trying new things. We had to do it on our water company to try to monetize the energy cost. We had to create essentially a new financial product to backdoor the energy to provide the water. So we had to take a very difficult route. The front door was just not available to us. And we had amazing resources. So it's a tough question. I think it's a tough question we all feel, whether it's an early startup, innovating at scale, or a private equity partner who's got capital expectations. And sometimes innovation is a threat, but you got to stay one step ahead of that threat. So I think it's a really tough question at the heart of it.
Okay, I'm going to, because of our time frame, I'm going to wrap this up. These gentlemen will be around. There's other questions. They'll still be here. You can ask those questions. I had a final question that was about what we at ASCE as a society, as an industry need to take on. But I believe Mark just handed us back the very challenge through our own words of how we have to think about this. I thought I couldn't have phrased it any better. So we're going to end the formal session, but I want to make sure everyone shows our appreciation for the generosity that you've given us with their time that you've spent with us and allowing us to have the kind of dialogue we rarely have. So our gratitude, many, many thanks. A round of applause, please.
Honored to be here.